everyone. Today is Friday, September 30th, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly presented by the Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves that you may have missed across financial markets. If you're brand new to this video series, first off, welcome. Thanks for being here. Thanks for joining us. Here's how these videos work. In part one, we look at everything that went on this week in markets. We pick apart the numbers and standout moves that are notable from a historical context. And then in part two, we jump into the charts. We take a close look at price action, measure and map the trends and interest levels that we want to be paying attention to. So hopefully that sounds good to you. Let's dive into a very busy week. September is over. This was the last day of the month, and raise your hand if you are happy that the month is behind us, because it was a brutal month out there. In fact, we got fresh S&P 500 and Nasdaq drawdown cycle lows. So we are treading at new lows from the peak that we saw late last year, early this year. We had another stubborn inflation reading come through on Friday. The PCE came in at 6.2%. Expectations were about 6%. It is down from the prior reading of 6.4, but again, it's still this stubborn, persistent reading on inflation, and some can, parse whether it's core versus not, and the slight lag in some of this, and that's all fine and dandy, but this is still what the market is weighing on here, is of course inflation and the Fed's mandate to fight and battle that. VIX over 30. This is where we've been basically all week. I did a video last week. I was feeling like crap last week, but we did that price action video, and that was one of the core things we talked about, was caution warranted over 30, and VIX over 30 is just an uncomfortable place to be. You can't trust market moves when the VIX is over 30, and we're going to talk more about that later in this video. Worst month for utilities since 2008. So even the safe sector is getting hit here. Obviously, a lot tied to what interest rates have been doing this week. And credit markets starting to break. That's a question, and we're going to look at that in the second half of this video as well. So let's jump into it here. The numbers on the week, basically 2 to 3% down for the broad averages here for the US indices. The Russell 2000 definitely standing out a bit better here, 0.87%. I gotta double check that if that's a slight lag on my data feed. I think it was down approximately 1%. I know it outperformed on a relative basis, but I thought it was at least 1%. But regardless here, 3% down in the S&P, Nasdaq 3, world stocks also getting hit here. And then take a look at the 1 month numbers. So this is basically September here, and you can see just 9 and 10% and 1 year numbers all just deeply negative now. If we look at the trends on the stock markets across the board, everything's declining. I'm not really going to spend any time here. This should be pretty self-evident at this point. Volatility environment. So again, this is where caution has really been, getting thrown into the wind here, because the VIX at 33.25 last week, it was 29.92, but notably it was finally breaking out of a range. Again, we're going to talk more about this in part two, but 3 points higher on the VIX, and then the Nasdaq falls up into the mid 30s, 36.85. Notice they're not quite at year-to-date highs, and that was some of our kind of game planning thinking in terms of road mapping this leg down here on where we think they could go. But 36, that's a nasty place to be for Nasdaq volatility. Now here's our old drawdown monitor. We're bringing it back because, again, we did get those new cycle drawdown lows. Basically, the S&P, the Nasdaq are at new lows. The Russell didn't quite tag new lows. I think it was very close, but still you can see now the Nasdaq at 34.58%. That's the approximate cycle drawdown just in this cycle here. World stocks about 31%. So things are getting ugly down there, and there's been a lot of selling over the past few months. Now, if we look at breadth, we are finally starting to get some noticeable washout readings. Whenever we get the number of NYSE 52-week lows into the comma column here, where we get 4 digits, that's where things get pretty notable. And Friday's numbers were preliminary here at 730. I suspect they're going to come in over 1,000. And when you start to get clusters of over 1,000 stocks hitting new 52-week lows, that tends to be in the vicinity of a washout point. But again, nailing that down to an exact day is basically impossible. So again, we'll keep a close eye on this, but we know that things are getting thrown out here, and utilities even hitting some of their biggest moves down for that type of more defensive sector. Again, I know this rising interest rate economy or environment that we're in is a little bit different of a scenario than we have in the past 5-10 years, frankly, but that's still notable. On the week here, about 3,800 in aggregate stocks hitting 52-week lows. So lots of negative. Let's take it to the surveys here. This is the AAII Sentiment survey here, and we are at bearish, 1-year bearish highs here. And quite frankly, I think it's multi-year bearish highs at this point in terms of the AAI survey that they send out. 61% bearish here. That's a extremely negative reading. And in this next chart, I pulled this from Charlie Bolello on Twitter. So check him out there. This is his research, his work, his chart over at Compound Finance. And he put this together. This is the AAII Sentiment survey. And it's funny because he's tracking only a 43% reading. So maybe this data set that he was using is actually a little bit old, because what I'm seeing here from the most current set is about 61%. And if that is the case and it translates to this, then going all the way back to 1987, this is some of the most fearful sentiment out there that we have seen, which again, is a pretty long time here, 40, 50 years. Again, sentiment surveys, I'm not, going to be trading exclusively off of them. And it is still extremely difficult to pick the exact day on these things. But everything we're seeing here, all the clustering of information is basically showing we're in the realm of a washout in sentiment and perhaps price and a bounce. I also wanted to couple this with this interesting chart. I found it on Twitter. The only reference I can give is this is from Bespoke Group blog. So unfortunately, I couldn't track down the specific URL. I hate using research. This is not my research. Check out Bespoke Group blog, and maybe you can pull this chart up. I couldn't find it, and I lost the Twitter mentioned link. So this is just a seasonality plotted here. And so this is looking at historical seasonality. So last 20 years, last 50 years, last 100 years in these colors. And basically what you can see here is that we've just pretty much exited the most bearish in terms of seasonality period for stock markets. And we're about to enter to pretty much the most bullish time where trends typically start to turn up, which is in October. Now, October is a tricky month because October also holds the record, I believe, for basically the most number of crashes, or where markets have seen some big spirals down. 1987, obviously a big one, and there's others in the mix there as well. So October can be tricky. So let's, take this with a grain of salt. But again, seasonality here, couple that with some of this washout in sentiment, and maybe, you have the ingredients here to be, if you're tactical, looking to catch that reversal. Now, sector performance this week was basically all red here. Energy was the lone standout. It was up 2.19% this week. So very much bucking the trend. Materials and healthcare in the second and third spot. And then here's utilities down 8.71%, just an absolute exodus here from utilities. That was again just breaking some records there. I believe this was the largest down month since 2008 for equities as well. So it was really rough out there. Technology and real estate in the second worst and third worst performing sectors. Now, in terms of industry rankings here, I want to throw in Investors Business Daily's data tables here, which ranks the industry ranks. So this is from their site. They update this every single day, and I just grabbed the top 10, but this is still the top 10 performing industries in the market here, and you still have solar at the top of the list. There is a lot of strength in there. Some of those stocks just totally ignoring the downtrend, and then a lot of energy, banks, and some assorted industries as well. So they update that every day. There's a link in the description. The link is also here if you want to get access to this on a daily basis, curate that relative strength. That's where you need to go. Now, in terms of correlations here, again, just bright green and red across the board. So essentially all equity assets here moving in lockstep with one another, just super high correlations like we've seen all this year, frankly. The dollar, strong negative inverse correlations. 10-year yield and what interest rates are doing, strong negative inverse correlations. And what I think was at least notable this week, especially for the crypto traders, is Bitcoin is actually starting to depeg a little bit, or just kind of do its own thing. And I tweeted this this week, and it's been persisting now, is Bitcoin's in this stubborn range where it hasn't quite made up its mind, but it certainly hasn't been selling off with equity markets on this latest leg down. Now, maybe that's the next shoe to drop. Maybe it needs a few more days, but it's definitely in sort of a breakout range where you want to start to pay attention to it. But the direction here is still unclear. Correlations, though, clearly dropping for crypto. Now, U.S. Treasury yields, this again has been a lot of the driving action here for what's been going on with just the macro in general. But basically, you know, we have continued week here with yields climbing on the week. Now, they didn't close the week at highs. So again, there was a bit of a tail at the top end of this. If you can imagine a chart on all of these yields, you could basically picture a nice kind of upward tail there, inverted hammer of sorts. And that is, you know, I don't know, mildly encouraging, I suppose, but still the direction here is firmly been up for the past several months now at this point, couple of months. And so we need that pressure to be relieved if we are going to catch that bid, I believe, in equities. Last but not least here, dollar and commodity performance. Again, Bitcoin kind of standing out, up 3.65% this week. Gold was also up and silver was up. Crude oil was pretty flat. Dollar index was actually down this week, so that's notable. We're going to talk about that in just a minute. It did put in a big topping tail of its own. So it did close down on the week. Ag was down. Natural gas also down. So that is it for part one of our show this week. We're going to spend a lot of time looking at price action and really trying to continue our conversation from last week and look for and plan for the scenarios here of catching this market bottom. Again, kind of geared a little bit to the short-term traders, or just what you know, what we could see here for some type of reversal event. So we're going to spend some time talking about that, game planning. If you do want to catch the full-length episode, if you're not already on thetraderist.com/SMW, you can just buy this episode for $5. That's why we did a single episode pass. Extreme times of volatility like this, or if you just want to catch up with some extra perspectives here and you want to hear ours, you can buy just the single episode for $5, or you can subscribe monthly and save yourself a few dollars if you wish. So that is it for me. Thanks as always for tuning in. I hope you have a great week out there. Hope you manage this volatility okay, and we'll see you back here next week.